Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And then it tried to break out recently, and again we saw sort of a breakout, but not nearly the breakout we saw in the other one. So here we are, we're looking at different strategies. And again, Steve was recommending, what could you do if you're bullish? Well, you could sell some puts, but again, I personally don't like selling naked puts. So what could you do? Maybe sell put spreads down, at some level. Well, another thing you could have done is maybe buy some upside calls, or maybe buy some upside call spreads. So you look for the breakout and then you try to buy it, or try to anticipate. Again, there's no right answer. Some of you have been to classes where they tell you never to anticipate these breakouts. Some of you probably have tried to anticipate it. Risk and reward are inherently linked, so the people that do anticipate at least a little bit probably get paid a little more. They also take more risk. So that's just a very important point. Canadian dollar, well, there we go. We see the breakout, and then it didn't go all that far. So you could have bought the breakout or hoped, that you were going to be right. But again, at some point, maybe you sell some calls. You bought 103, 104 calls. You sell 104, 105 calls against it. Or another strategy could be, Steve's actually still with us. He's just buy a pullback. So that's another strategy, and Steve can help you with all this at OTA. He's a great teacher. So you can go to OTA, and he's going to basically tell you just some other things that you can do. So hedging strategy, well, CDD was the first one to break out. So as I went on today, trading 103.59. So it actually broke that trading range of 104.25 to 107.65. So the retracement went back to 104.26. And again, some of us would say maybe we're in trouble with the U.S. dollar because it's actually come down pretty far. But at least if I look at this chart, a lot of technicians would say, maybe it's come back, but it's still somewhat more than likely in a bullish trend. So I don't know how Steve feels about that. It looks to me as somewhat bullish if you look at it just from a technical standpoint. Higher range so far, Steve's typing in. So again, take a look at the candlesticks last year. Those red sticks mean that the U.S. dollar is sinking just about every week. I think this is a weekly chart. And then the sticks started turning green sort of in November, December, and then they were sort of green and red, sort of balanced. So that's why I personally think that candlesticks are great, because it's just pretty simple to see the trend. You can look at the slope of the line, but you can also see red is at least in this charting package, and I think this is TradeStation. I'm not positive. That red is telling you that the close was lower than the open. The green's telling you the opposite. So again, a lot of ways to trade and a lot of platforms to trade. Of course, I'm not recommending any one platform, as that all the brokers are very good. They all offer different functionality. So Canadian dollar strategy, well, Steve was saying the retracement from 107.65 back to 104 should have been exited at some point to lock in the profit. So that's why you need to have an overall plan. Pullback entry to 104. Could be hedged using a bull call spread. Buy the 104, sell the 108. New breakout entry above the 107.65. So we're sort of in that neutral zone. Actually, we're a little bit below the support level. So this is what really tests us as traders, as if we're looking at the 104 as support and we break 104, some of us would be exiting and some of us wouldn't. So, again, you just want to keep your eye on it. I know some people are saying that the U.S. dollar is still in a bull trend, but again, that's up to you. Doesn't matter what anybody else really tells you. But again, firms like OTA can help you sort of learn more about it, so that they can help you understand where your weaknesses and strengths come from, so you can trade accordingly. EUI, well, look at this bear trend for a long period of time. I think we've been there for years, but just recently we see a significant bear trend. So Steve was saying look for a stage 2 breakout. Once the 30-day weekly average, the weighted weekly average reaches the trading range. So he's recommending the buy to 65 calls on a breakout, and I think that actually worked pretty well, right, Steve? Buying that, if you would have anticipated that or when it got up to that spot, bought some 65s or 66s, would have worked pretty well. You could have sold out maybe some 68 to 69. At least that's the way I would have traded it. And again, some of us maybe were able to hold on even longer because I think it went much higher than even that. But, I mean, there's a lot of ways to trade that. So it traded as high as, let's say, it closed today at 67.99. So I think it was well above 70 there for a short period of time. Or maybe it wasn't. I can't exactly remember. I think it was last week, though, as the U.S. dollar is very, very strong. These charts do indicate we're updated. I think they're about a week or so old. Yeah, as Steve said, yeah, the U.S. dollar rally was rallying until the bailout. And then when the bailout came, everybody knew there was a sort of a bail under for the U.S. dollar, and that's the way everybody's looking at it. But again, that's very, very important for you to understand it, and just look at it from your own trading perspective. You can buy protected puts. You can do a bear put spread. Bear put spread, what does it mean? Well, you can actually buy one put, let's say a higher strike put, sell another put. So there's a lot of strategies out there. You can buy, let's say, Steve say, buy to 67, sell to 66. So some would say, why would I do that? I can only make a point. Well, yeah, your ultimate profit is not going to be a point. That's going to be ultimate gross back, but maybe it only costs you 20 or 30 cents. So you look at the risk reward. I'm risking 20 or 30 cents, whatever the debit is, to try to make a whole point. Maybe that makes sense. That's up to you. This angle's pretty steep here. So you see the dollar rallying at least 2 weeks ago. And I guess the key point is how do you trade out of that? So you could have bought some protected puts. You could have sold some calls. You could have sold some higher calls. And premium writing makes sense depending on when the long calls expire. Also, take a look at the volatility and always try to ascertain the risk and reward. Does it make sense? And Steve's pointing out 11 days to expiration. So that's a dangerous trade. Be careful when you're trading options that are so short-term because when they're so short-term, you're just not giving yourself enough time. I would recommend that you, at least my theory is, if you think something's going to happen in a month, I always like to buy a 2 or 3 month option to give myself a little more time. Those options they are more expensive, and they also cut back on your leverage, obviously, but I think that it's a little less risky, but that's up to you, the individual investor. So SFC, again, a nice rally in the SFC, but again, the SFC's already down to 108-ish, so it actually, I think it pierced even 110 before that bailout news of last week. Now we're seeing the U.S. dollar come back in. But what's interesting is the U.S. dollar, as bad as the news is, I mean, it's just horrible, that the dollar is not trading down at any of those low levels that we saw in June.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.